Hello, those who've joined us. We'll be starting shortly. Need some hold music, elevator music. Shaun, are you able to just in your settings to change the sound notification for joining the meeting?
Yeah, let me have a look if I can. I can easily find it.
Just because if you start and then people join after, it's going to keep dinging.
That's right.
Welcome everyone, we'll get started in just a couple of minutes. So it's
I'm struggling to find out easily how to stop it. That's all right. I can deal with a little bit of dinging if that happens.
all right, all good.
Unless
I'm not
anyone
sure.
knows how to stop dinging when participants enter.
Let's try one more.
Don't worry about it. I'd say we just ignore it, don't we?
All right.
Or are you trying to do this for the training video?
No, that's fine. It's all good. No stress.
That's fine. All right.
Cool.
Well, welcome everyone to our first webinar of 2022. We're looking forward to putting on a whole bunch of these throughout the year. Today's speaker is Shaun Ganguly, and he's going to give us a session on financials in aged care, looking at the means tested care fee in depth, talking about protected persons and a few other things. In terms of questions, we will take questions throughout, so use the chat function though, please, to let us know what your questions are, and if it's appropriate for me to ask that question to Shaun in the middle of the presentation, then we'll do that. Otherwise, we'll save them to the end, but pop them in the chat as you think of them, and we will come back to them all. So thanks so much for your time in putting this together, Shaun, and thanks everyone for being online. It's great to see you all, and to all those watching later, welcome to this webinar. Over to you, Shaun.
Excellent. Hi, everyone. So as Anna mentioned, financials in aged care. Excellent. So if I get started, very brief introduction to me. What got me into aged care advice was when I went through it with my own family. So most of these answers are things that I didn't necessarily fully learn when I first studied financial planning, and they're things that I had to seek out as a practitioner, and that's why I do what I do. So a lot of this stuff is on the website, my website, and a little bit about me outside of when I'm not financial advising. So I'm often found riding my motorbike with my kids, and there's a picture of me with probably not the best army picture, so I love that one. So that was from a border protection operation. After 3 days of no food, no sleep, we were going after some weapons smugglers in in some waters off the north coast of Australia. Everything in the mission that could have gone wrong went wrong. And after all those days, I finally got some 2-minute noodles. The morning broke at 5 a.m. We could finally cook. And then someone snapped a photo of me. So, and I still do a lot of that stuff. So anyway, that's what occupies me outside of this. But today, as Anna mentioned, these are the things that we're going to be talking about. Means tested fee, protected persons, and just how important the financial assessment is, especially now. And we'll compare to what it used to be, because this is the thing with aged care. Everything changes so rapidly that things that I would have done a few years ago aren't the same things that I'd recommend or do now. So, and we should have a bit of time for questions at the end. Now, and I guess one of the things that we wanted to do with the committee is put these at a slightly different level. So there's a lot of just assumed knowledge here. Assume that, you know, we're all professionals who work in aged care. Things like RADs and DAPs won't need too much of an explanation. The fact that there is a means tested care fee. So we're not going to cover off too much on the basic daily and other stuff that comes up, but are completely relevant to aged care. But where I might start is with the age pension. So there's some fundamental rules when it comes to the age pension and how they do means testing that come into it. So the first thing is that you might have heard there's an assets test and there's an income test that comes in. So when it comes to the age pension, which is money that's in the door, and this is where most people over the age of 67 who meet the criteria, they're assessed on, for the most part, money in the bank, and assuming they're not working, or even if they are, employment income. And what they do for age pension is they either look at assets or they look at income, and there's a formula for both, and whichever is more stringent is the one that they apply. So one or the other. And when it comes to the age pension, they don't care about the family home for the most part. So for a single person who's living in the home, the family home is completely exempt for age pension. And anything, and should that person move into aged care, even initially, it's exempt for 2 years, but what you can, and anything that you do put into the RAD is completely exempt for age pension purposes. So it's quite easy to hide money away for age pension purposes when it comes to aged care with the RAD. And so for age pension, these are the rules that apply. But things start to get a little bit different when it comes to the aged care means tested care fee, because the same fundamental rules apply, but there are some important differences here. So age pension is money that is paid in, comes in the door, whereas the means tested care fee is money that you pay. Now, the assets are largely similar, the assets that they assess for the means tested care fee. But in terms of income, they assess a whole bunch of different things for income, but they include the age pension in as part of the income when they do the formula. But now, assuming for a single person who's going into care, the family home is no longer exempt. So we definitely will talk a lot more about the family home, but they apply a capped value to that, where it is 175,000, and that's the current figure at the moment. And this changes on a regular basis. Now, on some occasions, this figure can even be lower than that 175,000. Every now and again, I might deal with a regional property. I think I had one that was 130,000, or when it comes to things like retirement villages, where they look at the exit entitlement. I've had a recent one where at the first estimate, they expected, it was a quite high value. I think it was 280 or something, but after this retirement village took out all of their fees and their deferred management fees, the actual exit entitlement and the capital gains share received was actually less than 170,000. So we were able to change that assessment for aged care purposes. And I mentioned that for the RAD, that anything that you put in for pension purposes is exempt. But when it comes to aged care, you can't hide money away that easily. So if you go and pay the RAD, everything is assessed there. We'll go into the formula, but effectively, they add up all of the assets, plus they add up all of the income, So they look at both, and they look at the value of the family home, and they look at anything that you've put into the RAD. So it's very hard to hide from the aged care means tested fee when it comes to determining the fee. And so once we get all of these, then the next question then comes in. What happens with all of these different components? So just to break this down a little bit, is what they do is below 51,000, we don't really need to worry too much, because that's the point where most people are protected. And I'm going to focus more on the assets here, because there are people who receive large defined benefit incomes, and a lot of military clients who I deal with do have that, but they're in the minority. For most pensioners and aged care people, it's the assets that come in. So between this 51,500 and 175,000, that's where 17.5% of the assets are assessed. So and we'll talk about asset reduction in a second, but any changes to the assets when they fall between this mark, or for a couple, it basically doubles. So if they fall within this, then we can make some huge changes to their means tested fees and other aged care fees that are means tested that we'll go into. So that's the so-called bang for buck. Once we start getting higher than this, in terms of especially above 422,000 and those larger figures along those lines, then look, there still definitely is a reduction in the means tested care fee, but if the assets are too high, there's probably no big pension impacts, and they have less of an impact on the means tested fee at that point anyway. And we'll talk about that too. So once people's assets are above a certain point, then we generally stop planning around that means tested fee as much for the higher net worths, or when they've got a higher number of assets, because the fee is what it is. There's only minimal that we can do. And what we do is then we focus on doing things like protecting their assets, generating more income, and whatever it is, and a few other strategies around that. So, but this formula becomes really, really important, especially around that $175,000 mark per person. Now I do have the more in-depth formula, but these are the main components that they use to calculate it. And we'll move into it, but the home is treated in here. It's thrown in the mix with these assets. So the next thing I'll go into, I'll just talk a little bit about what are some strategies to reduce assets and income. So a common one is gifting. Now you can give away you can gift anything you like, but after a certain point, Centrelink treated as an asset. The reason being, the classic question I used to get all the time when I worked as a bank planner, I'd have people with millions of dollars in term deposits who'd say, well, can I just give it to my son or daughter, and they've got the money, I don't have it. And you can do it, but Centrelink will treat it as an asset for 5 years, and they'll deem the income on anything that you give away. So $10,000 per financial year, or $30,000 over a rolling 5-year period. Again, if we're at this between 51 and 175, that's where we can see a big impact for it. For a higher net worth client, it'll probably be minimal. It's also important to note, I'm purely talking about the financial implications of gifting. There are a whole bunch of legal considerations about if a power of attorney is using that power of attorney to gift money and benefit from it, where the POA document doesn't allow conflict transactions, but that's more the legal space. So the next one are funerals. Now, there's basically two ways we can reduce assets and income. Now, I'm going to give a lot of examples of just personal things that I've seen over the years. So with prepaid funerals, you can spend as much as you like. There's no limit. The most I've seen, I saw it was an Italian family. They spent $150,000 on mausoleums, which left them, it was just crazy. I wouldn't have said that they could have afforded it looking at their numbers, but they found a way, and it reduced their assets very significantly. Otherwise, now the general risk of doing this is that you're if you do prepay the funerals, it's the risk of the provider and their own solvency. But funeral bonds are indexed 13,500 like a normal financial product in a way, and there's a few different treatments of that where effectively the money just disappears into a Centrelink hole until the person passes away. So annuities, now where there's cash, I've just put there are some very specific aged care annuities that we use, which have the effect of reducing assessable assets. Where, as an example, you might have someone with, let's say, 500,000 in cash, and by putting it in one of these very specific aged care annuities, it'll reduce Centrelink assessable assets by a certain formula, which is generally around the 10% mark. So that can shave off some assets for the right people. Expenditure and home expenditure are quite big ones too. So as long as the expenditure doesn't leave a corresponding asset, then, and by putting money into the home, generally when there's a spouse involved, because the home is either capped value or exempt for pension, by spending money on home renovations and other things, again, if it fits their strategy, that can be a good way of reducing assets, or readying the home for sale is a classic one. And the other one is estate planning. And this is more of a tricky one that I do sometimes do, where you've got clients with capacity, one might be terminal. Then I mentioned with gifting, you're not allowed to gift money away, but you can actually do it through an estate planning strategy, where if assets are held by one person, if that person passes away, you can bypass the spouse. So the spouse isn't left with a whole bunch of assets. Requires a whole bunch of coordination. It needs trustworthy people to leave the funds to. The person needs to have testamentary capacity. You need to be fairly certain they're the ones who are going to pass away first. And again, these are just scenarios that we've used that you can do to reduce assets. In terms of income, I'm just going to gloss over this, but what we can do is we can hold an investment bond. We can put it in a custodian trust, which shields all of the income. So the assets aren't deemed, probably less used now in the low interest rate environment, but still a good one for clients from a few years ago. More for the financial planners here. Deeming versus deductible. This is huge. Some of these old superannuations pre-2015, where they've made commutations, the old formulas, previously they were better off doing that, but now with deeming rates so low, there's been plenty where we've just cashed them out, reduced their income very, very significantly. I've noticed a lot of the non-aged care planners sometimes who don't deal with it as much, sometimes this gets missed. So pretty important. Paying into the RAD. When you put money into the RAD, the assets aren't deemed anymore. So that can actually quite significantly reduce income too. And a common one is when people have rental income, what Centrelink assess is rent minus expenses. And people often just declare their rent. They don't put in their property manager fees and repairs and all the other stuff that goes along with it. So by properly recording that and the record keeping, that can also reduce income. So these are, at a high level, some of the strategies that we commonly use.
And just before you move on there, Shaun, they're common strategies that you use within the scope of providing advice to clients, and not to be taken out of context and done individually.
And let me say, this is general. Everyone, and I'm going to say it at the end anyway, but everything is so specific to the individual client. I've just given it's almost like the shotgun everything. These are the approaches. There's some that apply to some people, others that don't. Seek proper advice.
It's common for people to just suggest gifting and suggest funerals and prepay funerals, but I think it's also important to add the comment that, you know, make sure you get some advice around it so you're not giving away everything.
Yep. And I'll talk about where the opposite can apply, where sometimes higher assets are better than lower assets. So, treatment of the home. Now, I'm just going to almost gloss over this, but basically, unlike the pension where there's a set rule, which I'll go on, with aged care, the family home is capped for life at 175,000 while it's a home. Now, what often catches people out is that, let's just say $1 million house, which is, you know, probably on the lower end of Melbourne houses. If you go and sell that house it's no longer 175,000. Now it's that $1 million that's sitting in the bank, which will cause that means test care fee to spike upon the next review. A lot of people aren't expecting that. And rental income isn't exempt anymore. And an important point to note is that this applies to the family home, not investment properties. And generally, what Centrelink will apply is they will look at the home where you spend the most time, or the one that's of higher value. So that's a treatment of the home for means tested care fee purposes. The good thing to note is that if you keep it intact, it doesn't change. So what happens is, and I'm sure we all know, is before you go into care, you have to do an asset and income assessment, and that works out what that means tested care fee is. Now, for people for a means tested care fee, if you do submit the full asset and income, they put it into the formula that I've just showed you, and they'll spit out a number, which is the amount that is the calculated amount. And if you don't disclose those assets, so for people with high assets, and in a few examples, it might not be worth the admin just to submit all of that with large share portfolios, whatnot, to Centrelink. In situations like that, then we might not disclose it. But if we do it, we just have to note that they won't classify as a low means resident, which might be fine, unless it's done by accident here, and which I see sometimes. They won't be eligible for financial hardship, and they'll just be subject to these caps. So the reason I've put the ACFI funding in here is that what happens a lot of the time is that when the forms aren't submitted, the homes will actually charge that full cost of care at $259.26 per day. Now, if they were providing a high level of care, when they assess the client's medical needs, the resident's medical care needs, if they said that they're high on, not having the activities of daily living, behavioral issues, and with complex health, and they need enteral feeding, then with all of those things, then it would be $259. Makes perfect sense. Now, the problem is, I guess, what we look at is, what is the likelihood that someone has high issues with the activities of daily living and has behavioral problems at that same time? What we find is, if it was properly assessed, they probably wouldn't be all highs. So a lot of facilities, just with the funding or whatever it is, just from an administrative standpoint, there are people out there who are just paying the maximum without realizing that they could possibly be paying less, because the means tested care fee that they're paying should be capped at their ACFI supplement for that individual resident. So for people like placement consultants and others, and it's just important to have an idea of where the client fits on this. Now, I'm looking at emails from just last week where we didn't submit for a client, and they said hi, and basically we just asked, hey, can we please get that assessment? And the facility said, yep, it'll take us 3 to 4 weeks, and then we'll know exactly what we do. So, important thing to keep in mind. Now, there's annual and lifetime caps too, that once we pay it, and it also includes, one of the things that happens is the income tested fee for home care. So if they've been on a home care package for a while, that also counts towards the cap. So if they've, let's for argument's sake, already paid 10,000, then their lifetime limit is a lot lower. Perfect. There's some. Now, what happens if you overpay? This is a real example. This is our example from September last year. We had a client reach out, and it was just a really weird case, because it was the children of the mum who was in care. The children, they had plenty of money. They just paid the bills. They didn't know what was normal, what wasn't. They just paid the bloody thing. They got told to seek some advice, and by the time we submitted the forms, got everything together, we got them a $71,000 refund. So this kind of stuff happens all the time. And it's important to note the nursing home didn't do anything wrong in this situation. It was just purely they paid the correct fee at the time once we submitted properly. then everything got done. And yeah. So let's check for time. Brilliant. Okay. So the next point that we have is the protected person. So I've talked about what I've said is that the home is generally assessed for aged care purposes, but there are circumstances under which that own home can be exempted. Now, that's where a protected person is in there. The simple ones, look, I've never seen a dependent child in an aged care situation yet. The more common one is a spouse. So if there's a spouse living in there, easy. The home continues to be exempt while the spouse is in it. Where things get a bit trickier is when we look at these scenarios where we've got a carer who's eligible to receive an income support payment who's been there for at least 2 years, or a close relative who has been living there for at least 5 years. And this is the part that gets a lot of people. What is an income support payment? So firstly, an income support payment are the things that I've listed here. But what often happens is that a lot of people are receiving the carer allowance, which is a far smaller rate of payment. The care allowance does not count as an income support payment. So just the fact that they're receiving that, because with the care allowance at the moment, it's a $250,000 income threshold, income limit. So it's very easy for most people to get that. And there's an ADAT score, which works out the care level, the level of assistance that you're providing to that person in order to either qualify for the higher carer payment or the carer allowance. Now, it's a far higher burden of care that you need to provide. Generally speaking, it needs to be your full-time job, and that's why they've structured it that way. So a lot of the time, they think they're eligible, but they're not. And the other thing is that they just have to be eligible and qualify to receive one of these payments. So if they're older, the person, the carer or the close relative, easy. We don't have too many issues then. But where they're a bit younger, so even for someone like myself, my mid-30s, I'm not eligible for the age pension. If I was, now I'd potentially not on a disability support pension, I'm not. But if I was eligible as a carer, then I need to meet that. I need to qualify and be eligible for the carer. On the date of entry, I might be perfectly eligible. Let's say I'm looking after my mother, grandmother. But down the track, once they enter into an aged care home and I'm not providing that care anymore, I'm potentially no longer eligible to receive that payment. So that can go away, and we'll talk about what happens. But the main underline with this is all you have to do is qualify. And the main thing that knocks people out of this age pension and other qualification is asset and income eligibility to receive some of these. So even things like job seeker payment, I'm working, and there's different thresholds for an allowance, like a job seeker and a pension, which have much higher limits. So if you do have a younger person who continues to qualify with no assets in their name and job seeker, then they might be able to maintain that, but it's on a case-by-case basis, and it's very important to know if it's even a good idea. So, and that's what happens, that if we lose the protected person status, if they're no longer eligible, it can exempt the home while the protected person resides in it, and that can be day one of entry, happy days. But when it changes, then essentially $175,000 gets added to the aged care calculation. Now that can cause a rise in their means tested care fee by just adding 175,000 out of nowhere, or it can cause an increase in their DAC, which I'll talk about soon. Generally at the next quarterly review. So the important part is also that as far as I know, Centrelink don't really ask for continued status updates about that protected person status, and it's on the onus of the person receiving it and getting the benefits to keep Centrelink updated. So other ways that protected person status can be lost: if the spouse passes away or enters into care. Either there is no protected person or they leave the home. For a carer or family member changing residential status, if they move, that can be a big one. Changes in income support eligibility, I spoke about. And sometimes even when it comes to what I've seen with age pension is, especially where it might have been a family member who was a little bit older, when they receive an inheritance or other funds, then, and the other one is sometimes when the person goes into care, then then they're able to return back to full-time work, and they don't meet either the asset or income test anymore. If they lose that eligibility to receive that income support payment, then they're not a protected person anymore. And that can have these aged care implications. Or a pen, and this is the other thing that really trips a lot of people up. And I get this one's really common, where so it's indefinite if a spouse remains in the home. So let's just say the spouse continues to live on, easy, but assuming it's either a carer or someone else, a family member, then the 2-year rule still applies for remaining in the family home. So even though they might be a protected person for aged care purposes, for the home, for Centrelink, they can still lose that pension, which can be over $25,000 worth of pension, which can disappear independently to the aged care. There are certain hardship criteria, which we just don't have time to go into, where Centrelink has its own hardship, a different set of rules and other things that we can apply for that we've done to keep people on the pension, even when that happens, but for another day. But the 2-year pension clock, that dreaded, oh my God letter that comes in, basically starts when, if the spouse, let's just say we do have a spouse who enters into aged care. When they enter into aged care, then that's when that 2-year time clock starts, or when they pass away, which again is relatively common that we see. So important to note, protected person for aged care, protected person for age pension, they're two different things. Again, similar, but can have very different impacts. Okay, we're back on time now. So what happens is, the reason we submit these forms though, is that on day one of permanent entry, not respite, permanent entry, what they do is they look at the assets and income, and I'm just going to ignore the income for the most part. Let's just assume most people are on the pension, which they are. There are definitely anomalies here, where, I've got one where someone's getting $110,000 worth of CSS pension income. She's a retired public servant. Happens, less common. If we focus on the assets, if your assets are above this $175,000 line, which is shockingly the value of the home, also, you're assessed as a market payer where you have to pay the RAD. If you're below this line, then that's where you become a low means resident, partially supported. I hate that term, and I'll talk about why. So where we start looking at now, if the home's exempt, that's great. But where the assessable assets are somewhere around that 200,000 to about, I'd say maybe 160,000, or if there's family able to, give money, then even lower. We've got some planning potential where, because what happens is we plug this into a formula, which comes up with a figure, the MTA, which says they're either, if that formula comes in below $59.49, it's simple. They're locked in as a market price. If it's above, then they're a RAD payer. Simple as that. If they're below that, they're a low means resident. And what happens is that even if you're below the line, if you go win Tats Lotto the second day, you will remain a low means resident for life, which can be good. Sometimes it's not, but it's really important that it's determined by Services Australia. It's determined by the assessment you do, not by the aged care facility. You can't just decide. It's something you have to engineer based on careful decision making. And I'll talk about why I hate it. I just hate using the term partially supported, especially because supported implies that you're getting support, you're paying less. But the problem is that sometimes you pay more, which is what my next slide will go into. But that's why I call it the government accommodation price. So if you're paying this government accommodation price, sometimes people think, well, I don't have to pay a RAD. Easy. I don't have to pay that, 500-600 grand, whatever it is. But you still do have to. You have to pay a RAC or a DAC instead. Now, there's a formula, very similar formula, that works out what that DAC is. which converts to a lump sum, basically like a RAD, like a bond that you pay to the nursing home. But instead of the market determining or the nursing home determining what you're going to pay, this formula determines it. But what happens is, though, it's capped at what the facility is allowed to charge. So you can have two facilities next door to each other that have, and the same person going into either will pay a different price. So what will happen is when they work out this formula, assuming someone's below 59.49 upon day of entry, they will either pay this or they will pay the maximum supplement for that facility. So if they're a standard facility and 40% or less of their residents are low means, then the most they can pay is $29 a day, $29.09. Relatively simple. But if that changes and then suddenly they get an influx of low means residents, then all of a sudden that accommodation cost goes up. And then they get a bit of funding and then they go do a significant renovation where they meet the right criteria to get that funding. Then all of a sudden, bang, nothing's changed. And within a few days, you can have that same person's fees go from $29 a day to $59 a day. And look, the good part is that as assets and income reduce, then your calculated DAC here can go down, but it's no longer completely in your control, especially if you're at these higher levels. Then it just, yeah, it will depend completely on what that facility is doing. So, and this is where, when it comes to, before I move on here, is that when it comes to being above or below the line, previously, a few years ago, if you can, the name of the game used to be, oh, if we can use some of these cool strategies to get people under the line. Let's just say all things equal, you might have had a person who married couple with $200,000 in the bank, and with one person going into care, the other person's got good health. Then previously, I wouldn't have even given it much thought. I would have just said, all right, this is nice and easy. Let's take out a funeral bond, prepay a funeral. Let's give away 10,000 to your, son, daughter. Let's, do some renos on your house, whatever it is. Get this stuff involved. Get it done. Get you below this orange line, and then you're a low means resident. And for the most part, it just sounds better all round. And then they wouldn't have had to pay the RAD. Now, and again, there's a whole bunch of assumptions, assuming the facility itself doesn't mind taking low means, they're chasing it, whatever it is. But now though, one of the things I've got here is I've said that the RAC is divided by the MPIR, which is the interest rates. What that means with the interest rate as the denominator, the interest rates in 2016 used to be 6% for the MPIR. Now, we're a fraction above 4%. So when we're dividing by a smaller number, it means a bigger overall amount. So I'll talk about the difference between these two and just how I approach this now. Because a partially so-called supported person can actually pay more than a market price payer. And this happens all the time. So let's just say John enters fully supported. Let's just say he's got a protected spouse in the home. The home's worth $500,000. He's going into a place with a $400,000 RAD, which is fairly normal, and they've got $100,000 in the bank. On the day one of assessment, we divide the home is not included because he's got a protected spouse in. He's below this $51,000. Because it's 100,000 divided by 2, all he has to pay is a basic daily fee. Easy. And people get lulled into this thinking, oh, yep, there's 53, 56 a day. It's covered by the pension that John would be receiving, a full age pension. Don't have to pay too many aged care fees. Nice and easy. But what if the spouse loses her protected person status? Something happens. Let's just say she doesn't pass away for now. Let's just say that she moves into an aged care facility on her own. What then happens to John? So there's a quarterly reassessment that's done. When this happens, prior, he just paid 53, 56. As a low means resident though, all of a sudden, and I'm also making the assumption that he's in a new or significantly refurbished facility with more than 40% of their residents low means. So this supplement applying. In this situation, what they do is his daily payment, that would go up to $59.49. And that would happen regardless of when he went in. But the equivalent rack that would be calculated actually works out to now $537,000. So to put it another way, for him to make this $59 of DAC go away, he'd have to pony up with 537 grand to make it go away. Now, if he entered the same place as a market price payer, as a RAD payer, it's $44.27, which is 400,000 that he would have needed to make that go away. Now, that 44.27, now this would be a slightly different scenario if it was a 40% or less low means, and then he might have been capped at $29 a day. But the reality is we just don't know what's going to happen with the nursing home. They change, like it or not, this 40%. There's a lot of the facilities, they try to maintain above 40%, especially more, I see it in the not-for-profit space. But, unfortunately, it's aged care. Numbers drop. If a whole bunch of people pass away, other people enter, these ratios change all the time. There's ones that literally hover between 38 and 42. You can't keep up. So now that's now. Had he had entered in September 2016 when it was a 6% rack, that's where it would have been simple. The most he could have paid at any point would have been 361,000, which is still better than the market price. And so even that same contribution would have led to this fee going away. So that is one of these big changes that happen. We're not going to get fully into the numbers, but if it's even more pronounced when the spouse passes away, because all we've done is add $175,000 to the mix here. We're still dividing all of the other assets by 2. When the spouse passes away, it has like that double whammy effect. We're no longer dividing the assets by 2. And for the purposes of the age pension, there's actually a change in the thresholds that are used for a single person or a couple illness separated. And that, even if nothing else changes, just a change in threshold can destroy people's pensions. So there's a lot of considerations that come along. So when it comes to deciding, and this is why I'm saying that it's no longer simple to determine whether or not someone's better off as a RAD payer or whether they're better off partially supported. Because there's genuinely, as someone who does this all day, every day, I can't eyeball it anymore. I literally have to do the sums, look at the facility, and there's a few things that I look into. So the biggest thing that happens is probably incorrect and old asset information. This is the thing that stuffs a lot of people up on day one. So I know what happens is when this assessment is done, often, so just off the top of my head, for a single non-homeowner, you're allowed to have 270 or 200, just over 270,000 worth of assets before your pension starts being reduced. So for a lot of people, especially if they've got under 250 worth of assets, they might have old, not, incorrect asset information, which has no impact on them because they're getting the full pension. It literally doesn't matter. They might have had managed funds that they closed in 89 that they've still got listed, and shares and other things that just disappeared at some point. That what's the point if it's not going to have, no one wants to queue up at Centrelink if they don't have to. If it's not going to do anything, unless they're a retired accountant, they're not going to do a thing. And I wouldn't do any differently. So if their assets, as an example, for a single person, were at 200,000, when they submit this assessment, especially with the smart form, and they don't update their details, then when we do that data pull, they can be categorized as a RAD payer. When in reality, they might have only had 100,000 in the bank or something less, where they should have been a low means resident from the beginning. So this can cause issues. I'm actually dealing with one that was the exact opposite. I've got someone who they were fully supported and they just felt they didn't they didn't realize that they had to tell Centrelink about an investment property that they purchased in the 80s. I'm not looking forward to the results of that one. True story. I haven't got the results back yet, but I've prepared the family. That was a 2016 entry, and they've been fully supported since. They've been receiving a full pension and only paying. Anyway, we'll see what happens. So that's one thing, making sure we have completely correct information. The next one is same day and different day entry. Now, some of the placement people might have heard about this, where while there's a protected person, this just refers to the first day of aged care entry. If on the first day there's a protected spouse in, we can shave $175,000 off. So if a couple goes in, it's 16th of Feb now. So spouse enters in on 16th of Feb, and then the other person enters on 17th of Feb. The person who enters on the 16th of Feb is not assessed with the home because they've got a protected person in that day. Even if they're in respite, that's fine. But if they enter in on the same day, then they're both assessed on that 175,000. That itself is one of the most important decisions to make now, deciding, do we do a staggered day entry or do we do the same day entry? And again, previously, a few years ago, you always just did staggered day for the things that I showed you before. Now, there was one that I did a few months ago, just from a financial cash flow perspective. There was about a $12,000 difference in cash flows by going same day due to the cost of the RAD and how much they had. So they were better off going same day, not supported. So very common now. Now, this is where, especially sometimes not claiming that protected person status, more for you can do it with a spouse. It's a checkbox that you tick. And sometimes it's even, if it's a non-spouse, other than that, you don't necessarily have to say there's a protected person. It's how you fill the forms in to get the impact you want. And so that's where you can create your own outcome. The considerations, we always ask about the ratios. Like usually if we're doing advice, we'll ask a facility. We have to go to the finance department and ask, what are your supported ratios? What do you count as, to figure out what's this person actually going to pay? If it looks like it's a standard and they're less than 40%, we can actually tell them, you know what, balance of probability, this is probably a good option for you going in. An important one, just to have a direct conversation about what's likely to have happened with the carer or the spouse. So if I go back to my example here, let's just say this person went in this way, John, who goes in. If he's, and we never know, no one's got a crystal ball, but if he's got, let's just say his spouse, Jane, she's in good health, looks like nothing's going to happen. He's got early onset dementia, something along those lines has happened, and she's doing well. We don't expect anything. As a consideration, they might actually be better off going in as a low means, because then that would keep him in this fully supported territory for the foreseeable future as our best guess. If it looks like as soon as he leaves the home, then she's likely to follow suit soon after, then it's a lot more important to look at, well, what are the different options? Because yes, we're doing this on day one, but in 3 months' time, this is probably going to change. So let's look a few steps ahead. Will the asset position reduce? Now I had one where they did the assessment. They thought they put some money aside in what they thought was a exempt funeral. It was a term deposit. So it fully counted. And they were like right on the line when they went in, like we're talking within a couple of grand. If they sought some advice and at the time they were over the line, and they saw me months after, but had they seen me, we could so easily have got her under the line. And now she has to pay a RAD unless she moves facility or has a 28-day vacancy. We're probably not going to change her, but for someone like that, they probably would have been better off as a low means resident. So look, if we're expecting that, then might not be a bad option. Now, the other thing is sometimes a higher RAC or RAD can be better. Now, the reason being, in this exact scenario, if we sold this $1 million home purely for pension purposes, we can shelter more funds away here at 537 for pension purposes than we can at 400. So again, there's just these multitude of factors that we look at that it's just not simple anymore. It used to be a lot more simple. And unfortunately, things have changed a little bit. So
just before you move on there, Shaun, because you just touched on it, one of the questions has come through, can you ever be reassessed to change your status from supported to a RAD payer? And you did sort of mention if you change facilities or 28 days. Can you just quickly expand on that?
yeah, so what happens is that if you change RACS ID, so where a facility, as in I've seen them when they've closed or they've moved from a facility, if there's been a major change in circumstances, then they reassess your circumstances. And under those situations, yeah, absolutely, you can do it. Same with you need a 28-day absence from aged care. Now, that's what the legislation says. And I have once or twice seen where they've gone unfunded respite and the facility itself, where they've got different, they've changed coding. They've just been a bit tricky where the person hasn't actually moved and we've just been creative. Not all facilities allow that. I tried to pull that with someone else and they were just like, nope, it's not going to happen. You need a 28-day absence. So yes, it can be done, but not under financial grounds. So if someone goes in as fully supported, let's just assume they're not exiting for 28 days, which for the most part, you just can't do. They're not doing that and they're not moving facilities, then even if they win the $30 million Powerball, they're going to remain as a supported resident for foreseeable future. Cool. So, so this is just more that in terms of a summary is that change is inevitable in aged care. Sometimes this is one of the probably the biggest differences with aged care and a lot of other things that we just need to plan so many steps ahead. Now, of course, there's a lot of crystal balling. We can't say, when's this person going to pass away? But just having a good, honest, direct conversation with the family, the clients at times, sometimes the spouse, if that's happening, because there's probably going to be sales of home at some point, or the home's going to be accessible, changes in assets, things like debts, family circumstances with protected people, especially if you've got full-time carers. And you also don't want finances to be the drivers of the choice of the aged care facility. The best thing for the person going in, and hopefully the finance is just a secondary consideration that we just don't even have to worry about. There's a whole bunch of legal and estate planning ramifications that are beyond the scope of this presentation that we really have to think about too. And the most important part is that it has become increasingly complex in the last few years, that there really is no standard fit. I get asked by clients all the time, hey, what's a rule of thumb? What about this? What about that? And I quite genuinely just say, look, I'd be doing you a disservice a lot of the time by coming up with a rule of thumb and just giving you a quick answer, because for the most part, I genuinely don't know until I start modeling it out and looking at these scenarios and talking about, well, what about this and what's their health and these are certain circumstances. It can go any way, and it takes a fair bit to determine what the best option is. So that's what I've got about financials in aged care. Hope it all made sense. Open up to questions now.
Thanks so much, Shaun. So if you've got questions, just chuck them in the chat. To kick off, a question around the treatment of the family home when an adult non-dependent child has lived in the property all their life. Is there exemptions that you can apply for? And my add-on to that is, does that fall under hardship?
It does, yeah. So what you can do is there are some Centrelink age pension provisions around it being unreasonable to sell the home. So if a close family member has lived there for 10 plus years, and there's certain rules that we can apply for, and there's other aged care hardship provisions. So that adult family member can definitely come into it, and we've done that previously. So again, we just have, but there's the way Centrelink work, there's a set of criteria that get asked, and every single one of those checkboxes have to be met before we do it. But yes, absolutely.
Very good. Yeah, I think the way I've explained it to clients over the years is it's kind of they're a spouse without being a spouse. You just have to, but Centrelink have a process for everything, check boxes galore. Okay, Shaun's explanation on supported versus financial hardship. Oh, sorry, Dave. Do you want to expand on that question?
Oh, let me just read that now. So, financial hardship 12 months after. Yeah, okay. So with supported is a status that comes upon day one of entry, and that's given to you, and those are the fees that you pay. When it comes to hardship, there's a different set of rules that apply. So, and it's something that you generally have to apply for every 12 months. So under aged care, we'll just talk about aged care while we're doing it. So for aged care, it's the SA 462 that you have to fill in for hardship, but your assets have to be below, it's something like 37,000. You can't have gifted in the last 5 years. And there's about 4 or 5 check boxes that you have to meet to make hardship. And then they'll cover, depending on your circumstances, they might cover things like, I've seen basic daily fees covered, means the assessed fee. They'll even pay for your pharmacy and personal expenses through these supplements. But you have to, it's a pain because you have to apply every 12 months. You don't get notified of it. They'll just cut the payments off. And just administratively staying on top of it and continuing to meet that is its own thing. So it's a more ongoing process when it comes to hardship.
Yep, agreed. Liza Lee has a question around
Cool.
paying expensive funeral costs. Wow, yes, the
Yep.
prepaid. I think the point here, prepaid funeral. If you spend 100,000, then you're not. Her question is, if the funeral only costs 50,000, does the estate get to keep the balance? I think
that is super important. So if you do, this happened a lot during COVID where people had prepaid these funerals with like bar tabs and all of that, and which is great. Free planning. I wouldn't mind a bar tab at my own funeral. But when it came to COVID, then all of that stuff was out the window. We were doing like Zoom funerals like this where the costs were significantly lower. So it is completely between you and that. It's now a contract between you and that funeral provider. If you paid them, $50,000, $100,000 for all of this stuff to shelter Centrelink assets, it's between you and them. If they don't want to give it back to you, then you're out of luck. So I very, very rarely recommend that to clients. The only time I recommend it is when they've got, and this is a general rule, but if they've got a spouse who's already passed away somewhere and they want to plot next to it, and we just know that is going to happen, then by all means do it. But what I normally recommend is financial advisor thing, but a funeral bond. But instead of making the proceeds of that out to a particular funeral director, we have it go to the estate. So let's just say it's 13,500. It hasn't grown. It stayed flat. Upon the person passing away, 13,500 then gets paid to the estate, and they can choose to do whatever they want with that 13,500. If they want to spend $500 on and that might be they have to because it's COVID times and that's all it is, then so be it. If they want to go all out and then spend 100 grand and take another 70 or whatever it is, 87 from the estate, then that's also their choice.
yeah. Just adds to the complexity that there's no one size fits all from that. Question from Kerry. Are you seeing a lift in families considering having in-home care now, longer having members admitted than having them admitted to aged care facilities?
I'm seeing a lot who are considering it, but then when they hear about the wait time for a for a level 3, level 4 home care package and the impossibility in practical terms in Melbourne and Sydney of getting one of them, and the astronomical costs, and I've made a few referrals to Nick Dunn, who from the private care perspective, and then when they realise it, then suddenly having all of your meals, all of your utilities, all of your expenses and everything covered for aged care doesn't seem all that bad. So I'm seeing people consider it, but once they consider all of the costs, probably aren't considering it as much.
Nice. And an add-on question is how are families funding cash flow medium to longer term, given we've got, if we're not selling properties and so forth, do you have what sort of solutions are you looking at to accommodate potential shortfalls?
Yeah, so look, this one depends completely on the family. I mean, one thing I have seen, because we've seen such a booming Melbourne market in the last few years from a property market perspective, I've actually had a few where the families have just thought, you know what, we've got a $4 million home or whatever it is. Let's just say a Brighton Camberwell home for this much. We know that we're going to lose 25 grand of pension, and we may not, let's say, for argument's sake, we have to pay a DAP. Then there's sometimes where, especially where we've had close family members say, you know what, let's just do this ourselves, because that $4 million home is going to be worth 4.5 the next year. They're happy to do it. So there's a bit of that, but it's just letting them know though that after 2 years the pension will go away. Most people, look, for the most part though, if they have the first 2 years worth of cash flow, we'll look at the options around it. But in terms of medium to longer term, everyone's different. Look, if they've got cash, if they've got super, then we can look at those options. If they don't, it's just,
Yeah. I think that's a perfect thing to finish on, given it just sums up that it's not straightforward. Every person's situation is going to be different. And I guess from a non-planner perspective, it's comforting to be able to tell that to clients. So everyone's position is going to be unique. And so the importance of making sure you get the right advice for your own situation is obviously really important. So thank you so much for that, Shaun, and to everyone listening either now or later. These webinars are run by members for members. So if you've got a topic you'd like to also share with us about, then please get in touch and we'll book you in. Any last words, Shaun? We're all good.
no, nothing. I'm all good.
All right. Well, thanks everyone, and we'll see you next time.
Thank you. Great, Shaun.
Good job, mate.
Jay,
Cheers.
really, really good. Thanks so much. Really thorough.
Oh, thank you. I'm around too. It's on my Zoom. If anyone has any questions too, I know I can just stop this recording. If anyone, like while I'm here, more than happy.